Central bankers aren't enjoying the best of times as the developed economies of the world crumble, thanks to, among other things, some dreadful policy decisions. I spoke to one of Australia's most respected economists on the world stage, Professor Warwick McKibbin, who vacated his seat on the RBA board last month. Warwick McKibbin, you've been quoted this week as saying that the Reserve Bank of Australia board could do with more experts on it rather than business people. In fact, the Australian Central Bank is the only one in the world that has business people on its board. So do you think that is a good thing or a bad thing?
Well, I think it's proven to be a good thing to have a mix of inputs into the decision-making process. My comments were just in the context of having a bit more balance between the important advice that you get from the business community, more expert input by experts, not necessarily academics, and I think it's very strange for the Secretary of the Treasury to sit on the central bank board. There's a governance issue which I think needs to be addressed.
Yes, but are you saying that causes a problem? I mean, are you suggesting that in times of stress, the structure of the Australian Reserve Bank board means that they're less inclined to target inflation?
Well, I just think it's better to look at a problem before it becomes a problem. And in the past, this doesn't seem to have caused us a great deal of difficulty in the last decade and a half. But I think given the stress that we see coming in the global economy, where we're going to have a combination of quite a high inflationary shock as well as quite a bad slowdown in economic activity in some parts of the world, the shocks that will be facing the Australian economy will be quite complex. I just think a bit more expertise with a different view than the bank view might actually be helpful.
You talked about the potential for rising inflation. In fact, we're starting to see that now with rising core inflation in the US. There's a real tension, isn't there, between the potential for inflation and the fact of inflation and also high unemployment and weakening growth. So what sort of a position do you think the Federal Reserve is in?
Well, they're in a very difficult position. What's happened is that, and we've seen this already twice this decade, in the early 2000s, interest rates went very low. There was no sign of US inflation, but because of the pegged exchange rate systems in China and other countries, inflation in those economies rose, energy prices rose, commodity prices rose, and they were imported back into the US economy through trade, but also through the fact that a lot of US goods are traded in world markets. And the inflation surprise in 2004 caused the Fed to start raising rates, and that's really what caused the disruption in the housing market. And so we have seen that in the first half of the decade. We're seeing it again now, and I think the inflation channel has changed. There is a global inflation shock in most of the large developing countries, and it will come back in through the trade channel into the US. The $50 billion question is, will wage earners in the US be satisfied with lower real wages because of higher imported energy and food prices, or will they start to bid up wage increases? And then it comes down to the question of, what's full employment now in the US.
But the US bond yield is around 2% now. In fact, on Thursday night, it went below 2% for the first time in about 60 years. So the markets seem to be worried about deflation, not inflation.
Well, there's two components in the real interest, the 10-year bond rate. There's the real interest rate and the inflation component. But I agree with you. That's the big puzzle to me, is why aren't people in the US concerned about high inflation? When you talk to American economists, and I do that regularly through my contacts at Brookings, they really don't see inflation as a problem at all, because they're looking at the output gap in the US, the high unemployment in the US, and the US is no longer a large closed economy. It's a medium-sized open economy, and I think they've just missed that channel that Australians have been aware of since inception, and that is that global inflation cannot be kept out of your economy except through a flexible exchange rate. And the US dollar's falling, not rising, and a lot of countries are pegging to the dollar. So that flexibility really isn't there. So the exchange rate mechanism as a guard against imported inflation, I think, is just not something the US can rely on, and therefore they have a problem to deal with.
In fact, I would have thought the US authorities would be delighted if they got some inflation at the moment.
Well, actually, inflation's rising in the US. It's also rising in Europe, and by my guess, it's between 2.5–3%. That's a high inflation rate when you've got unemployment around 9 to 10%. It is reminiscent, actually, of the early 70s, when we had both rising inflation and unemployment, where there were some fairly big structural shifts in the global economy, and people misunderstood them as cyclical adjustments when in fact they were structural adjustments that were required. And that partly explains, I think, the policy mistakes that have been made in the US and Europe in recent years.
Well, what do you think government policy in the US should now be?
Well, my view is that the US, it's pretty clear what the US fiscal stance should be, and it's not cutting government spending today, but it's actually cutting quite substantially future government spending and raising future taxes. So a very large expected future fiscal consolidation would instill a great deal of confidence into consumers and firms. And then the Fed's role, I think, is to announce a reasonably high inflation target, that inflation in the US will be 5%. And that will jolt people's expectations. That'll be a realistic assessment of what's likely to happen in the US economy. And I think that shift in the inflationary expectations and the fiscal deficit expectations is enough to start the economy to recover. But it's not going to boom in the US. We've been through a fairly significant asset price deflation, a lot of balance sheet adjustment required. And that the US and Europe are always going to be going through a very painful adjustment process, and it's been postponed by shuffling assets around and the government taking on a lot of the bad debts of the private sector. And the sooner that people grapple with what the problem is, over time the US can grow out of this, but it's going to take a long time before we see the sort of growth rates in the US that we've been used to.
Well, just turning to Australia now, do you think Australia is suffering from Dutch disease?
Well, not really. It's a complex situation because the Dutch disease is really a closed economy story, that if someone's, well, not closed economy, but if you don't allow flows of capital and labour, when one part of your economy expands, another part has to contract by definition. What we have in Australia is the capacity for labour to flow in through migration, and that's what actually has been happening in the first part of the resources boom during the mid-2000s. And we have the capacity for foreign capital to flow in. So it is possible to have booming sectors of your economy at the same time as other sectors of the economy continue to grow. And I think that's where the focus has to be on understanding that the ideas of the 70s and where there were capital controls and low migration don't necessarily apply today. There's definitely a structural adjustment going on, but I don't regard it as a disease. The fact that our wealth is rising because foreigners want to buy what we produce is not a disease. It's a good news story. We just have to manage it more appropriately than we have.
Thanks very much, Warwick McKibbin.
Okay, thank you very much.